Good afternoon. I'm Mike Manning from NEPC, and I'm really excited to have you here with us today to go through our NEPC 2021 market outlook. Joining me today are Phil Nelson and Jen Appel, both of whom are from our asset allocation team in our research area, and they're going to go through a lot of great information. I'll provide a quick update on NEPC. We'll go through an overview of the markets from last year, talk about some of our forward-looking key market themes and strategic outlook. Jen will give an update on perspectives on inflation, and then we're hoping that we can answer some of your questions today, finishing up in roughly 40 to 45 minutes. So maybe just in terms of logistics, one of the questions we normally get is, are we going to be recording this session so people can go back? So the answer is absolutely yes, we're going to record it. We'll post it on our website, and the slides will also be available. We also encourage you in the control panel for this webinar, if you do have questions, please put those in, and we'll do our best to get to all of those as time permits. So I'm going to shift gears now and jump into a quick update on NEPC. In terms of the overall company, we've got about 328 employees, 395 clients, and 1.2 trillion in assets under advisement. Relative to other peers in the institutional investment consulting space, we are the most diversified, if you look in the lower right-hand corner, by our client type. So we work with anything from corporate plans to private investors, to public plans, to healthcares and endowments and foundations, a really broad array of client types. And we think that breadth helps us understand different investment challenges, and we can bring that expertise across all of our different client segments. One of the questions that I get asked quite a bit is, and we're trying to, in talking with you, is talk about what's new this year, right? How are things different? And the reality, and pardon the bad dad joke here, what's new this from last year is virtually everything. And so we've had to, starting last March, like the rest of the country and the world, have had to figure out a new way of engaging with each other and with our clients. And that means everything from, how do you do client meetings effectively in a Zoom or Teams environment? How do we do manager due diligence, where we're used to going on site? How can we replace that? And we think we've actually found advantages, the ability to get access to more senior people more frequently, because frankly, they're not traveling. How are we going out and engaging with you and connecting you with our research team? Again, I think this is one of the things that will last, the ability to bring more researchers into meetings virtually, where our researchers are spending less time traveling and more time talking directly with clients. We think is one of those benefits that will last going forward. And frankly, I think we'll see more client meetings that will be done virtually. Certainly, we're all looking forward to getting back and seeing you in person. That's one of the main reasons that people like me and Phil and Jen get in this business, is to make those connections and be a trusted advisor for our clients. And we think doing that in person is really critical and one of the energizing aspects. So we're excited about getting back together in person as soon as that can happen. Our client conference this year, we'll have some more details on it later, is going to be virtual. So that is, what was the different about 2020? What's the same? And you've seen this from NEPC before. Our goal is to feel small but be big. And so what does that mean? Feel small means that you feel like we are 100% focused on developing a customized solution for you. It's not a one-size-fits-all investment solution. We've got dedicated experts who work in your client segment or in the particular investment area of focus that can anticipate and meet your needs. And we can also identify niche managers and niche strategies, as opposed to just having to take the biggest names out there. So we really want to be able to go across that whole continuum of working with you, so it feels like a very a tight partnership that we have with our clients. But we also want to be big, and what that means is we want to have the deepest resources we can to cover the whole landscape of investment ideas, of investment managers, to be able to use that size by getting better access and better manager fees for you and your investment programs. And finally, as I mentioned before, we want to share the learnings and insights that come across all of those client segments so that you benefit from those. Maybe just another quick update on NEPC. We're really excited to welcome 3 new partners into our partnership: Margaret Belmondo, Shanae Edwards, and Judy Murphy. We also have 9 new principals this year. The 4 you see on the left, Rick, Linda, Will, and Elton, are all folks that have been at NEPC for quite some time and have, in some cases, grown up here. The folks on the right, Scott, Andy, Jesse, Alec, not Alex, excuse me, and Troy, they are great senior professionals who chose to join NEPC in the last 12 months. One of the hallmarks for us is we talk about being the consultant of choice, not just for you and helping implement your investment program, but also for people who want to make investment consulting and research their career. And we think we've been able to do that. 4 of the names on this list came to us from other consulting firms. And we think being able to tap into that reservoir of talent is really important to help us meet your ultimate needs. We're focused continually on how we enhance the client experience. I mentioned negotiating manager fees. We have a client hub portal where you can access specific information to your investment program, but also some manager research is there. So please talk to your consultant if you're interested in that. And then increase research output. In 2020, we produced a ton of research. I think Phil will talk about the investment decisions that we recommended at the beginning of last year made a huge difference for our clients in terms of their returns. And we actually just finished our internal research offsite, and we're going to share some of our internal presentations on the Client Hub portal. So again, please reach out to your consultant if you're interested in that. Diversity and inclusion continues to be an effort for NEPC, both in terms of increasing access and understanding in meetings with diverse owned managers, but also importantly, improving the diverse representation here at NEPC and making sure we're as inclusive a culture as we can be. So that's nonstop work for us. We continue to get better on those metrics, and just I think in terms of the overall culture at NEPC. And we're proud that we were seeing increased interest across all of our client segments and the different services that we provide, and want to take this opportunity to say thank you to those of you who've been willing to share our name with folks that in the industry or serve as a reference. Really, our goal is to do a great job for our clients, and that will carry the day in terms of allowing us to grow and continue to be successful. And so we're happy to report that we got great scores from the Greenwich Associates survey this year. And so just want to say thank you again to all of you who've been supportive of NEPC and look forward to continue to deliver on our promise. So with that, I'm going to turn it over to Phil and let him jump into the markets.
Great, thanks, Mike. We're going to spend a few minutes talking about returns from last year and kind of a look back. I think many of us would prefer to, frankly, in some ways, never look back in 2020. But we thought it'd be good to encapsulate what did we see last year. And I think one question is a slide like this really doesn't paint the whole picture and kind of does a disservice to all that we saw last year. And as Mike mentioned, one of the things he talked about was our messages around rebalancing. As we started the 2020, we came off a really strong equity year in 2019. We had this encouragement of rebalancing, and what we saw to start the year was really strong corporate earnings, some positivity out of trade relations between U.S. and China, and the first news items regarding coronavirus, and really from there it's been a wild ride to say the least, where we've seen the fastest, one of the fastest sell-offs in I think most everyone's lifetimes from an equity market perspective. VIX hits 80, and then one of the sharpest rebounds that we've seen with a lot of the incredible support that we've seen from whether it's the central bank or fiscal stimulus actions across the globe. And then from there, it's a steady stream of headlines, unique, strange, unusual equity markets that have done amazing. I think one of the most underappreciated, probably trivia questions that we'll have to look back is oil going negative, in 2020. But really the story is the equity markets and how much they continue to push higher with positive optimism around vaccine, an economic recovery, and continued support again, which will be a theme that you'll hear from us from central banks and fiscal policymakers. And really that that gets encapsulated in the changes we see in equity markets. Our S&P is up 18%. Interest rates are down 100 plus points, and that is the levers of the central bank really encouraging folks to push out the risk spectrum, and one that we think is likely to continue for the foreseeable future. And as we look, how do we kind of put a historical perspective on this? And when we look at the largest rallies that we've seen from whether it's trough to peak and then peak to trough in a single calendar year, 2020 has really no comparison other than 1932. And I think we've all learned that when you make market comparisons relative to the early 1930s, it's usually quite a volatile experience. And I think some of the items that have come up that are unique and unusual is one, seeing an actual shrink in global GDP where we've lost a couple $1 trillion of economic output due to the pandemic, but also what is that translated into, or kind of maybe somewhat the disconnect that we're seeing in the equity markets relative to economic activity. And what we've seen here is just this tremendous rally, especially in the tech sector and a small number of large cap stocks in the U.S., where a handful of these names, Facebook, Amazon, Apple, Microsoft, Netflix, Google, are of size or larger than the entire emerging market indices or the entire small cap index. So it's an interesting perspective that it shows here's what drove the markets in 2020 from a different view, and thinking ahead, do some of these other markets start to catch up? And is there reasons for some of these large cap names to continue to move higher with some of the thematic issues that we see providing a tailwind for equity markets. And this takes us to our key market themes. Many on the call who've listened before have heard us talk about our themes, and these really are items that we try to help describe what's going on in the market. And we think of them as the common denominator factors that influence market activity. And if we see disruption in these themes, whether it's a positive disruption or negative disruption, it likely, it has a heavy ripple through the capital market. And you see volatility, you see a lot of price movement. And, the two themes we'll focus, the most on are what we call our virus trajectory theme, which is one we put on last year for obvious reasons. And then our permanent intervention theme, which is one that we really think is the dominant driver of market pricing today. And this is one we've had in place for almost 2 years now. So this predates a lot of the action from the central banks and fiscal policymakers that we saw last year. Maybe first, just thinking about virus trajectory. This is not a theme where we're predicting the outcomes related to the pandemic, but what we're really trying to understand are what are the range of outcomes that we could see, both economic and markets, related to how we manage a pandemic, how we manage social distancing, how a vaccine distribution is managed. These things, do matter in terms of how they influence, markets and economies. And thankfully, we're seeing, a turn down in the uptick in cases, and hopefully that continues through the spring. And as the vaccine continues to roll out and really puts holds down a lot of these numbers. But I think the question that we have is, how long can the pandemic have an economic impact? And one of the things that we think about from a thematic standpoint is we hope this theme maybe kind of, for us, we take down in 2021, but does it have a lasting impact on economies in the markets? And kind of one example of that is thinking about, the long-term unemployed. The dark green bar here shows the number of millions of people in the U.S. that have been unemployed for more than 27 weeks. And this is steadily creeping up higher and higher and higher. And history tells us the longer one is unemployed, the harder it is to get back into the workforce. So I think the big worry is, do you create a group of individuals that are unable to rejoin the workforce, which has a long-term kind of scar, if you will, on the economy. And on the other side of it, what does a vaccine rollout look like? Is it fast, rapid, and efficient? In which case, can we get back to, a new normal relatively quickly? And, a historical backdrop of, the Spanish flu in 1917, once, folks, kind of got back to a normal, you did see this economic exuberance pick up. Is that something that we're going to see, if we have a more rapid recovery in economic stats? And that's what we try to kind of, frame our thinking around this thing. But really the dominant force is related to what we call permanent interventions. And it relates to the willingness and ability of monetary policy and fiscal policy to support both investment and economic outcomes. And so we look at, here in the US, we look at monetary policy and fiscal policy in 2008, 2009, the financial crisis, relative to today. And you can see there is a significantly larger and faster response that's been provided. And in some rounds, in some ways, we expect maybe another round of fiscal support to be coming. And we don't think of this as a short-term blip. We think of this as likely a part of the toolkit and policy that policymakers will employ. And we think about this in a way that when you think about what's the central bank policy mandate, historically it's managing inflation and looking to generate full employment or having inflation-employment imbalance. We think, and this is something we've been of the view for several years now, that there's really a third mandate, if you will, from central banks, specifically the Fed, and that's managing market sentiment. So that's managing, the markets. If you see, liquidity dry up, if you see credit spreads rise, if you see, greater fear, if you see fear rise in the equity market, we think central banks will employ, necessary policies to help manage that market sentiment out of the fear of what that can do to the real economy. And the fiscal response is really one that we think will also continue. Is, without some of the central bank support, you can really start to see, the deflationary forces that are very much still at play, whether it's in the US, Europe, or other parts of the globe. So the positive is we see permanent interventions really sustaining, higher valuation multiples for equities, and some degree, providing a backstop to investor sentiment. That is the positive side of the outlook. We do think this creates an undercurrent of, tail risks, where in some ways moral hazard is absorbed out of the markets and by, government balance sheets or the central bank, that does build risks over time, but maybe one that is less of an issue in the next several years. And this takes us to our strategic outlook, which very much ties back to some of the thematic items that just mentioned. And I think the overarching item that I'd say is to summarize 2020 is we tried to simplify our outlook, tried to simplify what we did in the face of really wide range and wild outcomes related to the pandemic, and really focus on what matters. And we boil it down to really an emphasis on strategic beliefs. And if you have lots of binary outcomes, it's harder to take, let's say, tactical bets. And you need to focus on what we'd say are the core principles. And in this case is, do portfolios have enough portfolio liquidity? So really emphasizing through whether it's a stress test in a portfolio or reviewing your safe haven fixed income exposure. Do you have the liquidity to support your needs from a portfolio objective standpoint? And thinking about longer term outcomes. What are the long-term investment objectives for your portfolio, and the long-term investment goals? And when we look at the dynamics of the next 5+ to 10 years, we see a bias in market pricing to equity over fixed income, and encourage folks to consider having higher strategic equity targets, just because, frankly, the return differential relative fixed income is quite wide, based on our expectations. And part of that's kind of reinforced, based on our capital market return assumptions, which we'll briefly cover, but also, looking back, relative over time, it's one of the widest differentials that we've seen, from return expectations for our U.S. equities relative to cash. And I think we acknowledge the fact that in some ways equities relative to history are probably a bit expensive. But at the same time, when we think about fixed income markets, you could argue, yields at all-time lows or near lows, and that return difference of equities and fixed income is a delta that we really can't ignore, and it really is re-emphasized by that permanent intervention theme that is keeping interest rates low and is really relying on the fact that should inflation remain stable and subdued, this type of market dynamic can continue longer than one might expect. And that takes us to a public market equity outlook from a strategic standpoint. We favor a bias to U.S. equity exposure and emerging markets, which really means that when we think about non-U.S. developed markets, Europe, Japan are the funding source for, incremental overweights. And I think the two items that we'd really want to emphasize is when we think about emerging markets, the higher return expectations associated with the emerging world are really tied back to the growth potential we see in emerging markets in Asia, which very much ties back to China in its development. And then second is really think about what's the risk tolerance, the liquidity risk tolerance that you have in your portfolios. Adding private equity, deploying active management strategies, we think is a toolkit we'd encourage investors to use. And part of that is represented by, from a public market standpoint, a bias to small cap relative to, let's say, global equity capitalization weights. And we think using active management is a prudent and diversifying way to add incremental returns in that space. And in line with the back to basic comments that mentioned earlier, is really a re-emphasis and a focus on talking about safe haven fixed income exposure. And so what do we mean by safe haven fixed income? These are exposures in a portfolio that provide a liquidity source in times of market needs or market stress, and offer a downside protection benefit for the entire portfolio. So really a negative correlation or a neutral correlation relative to risk assets and equities. And our observation is we see treasuries are the best provider of that benefit. And we would encourage many of our clients to have a dedicated allocation of treasuries in their portfolio, but also think about relative to what their objectives are. Think about what's the right safe haven for relative to your investment objectives. So a insurance company may have a very different kind of safe haven or safe portfolio relative to an endowment. And we encourage thinking about those objectives and tying it back to the safe haven allocation. And so for most total return investors, we'd encourage a blend of treasuries and TIPS to provide a diversified interest rate exposure. But I think the most critical item is really emphasizing that you have the sufficient liquidity to support the portfolio and cash flow needs. And I think the piece that I think is underappreciated, and at times of low interest rates, governance matters quite a bit. And one of the items that we see is as interest rates continue to stay low, there's an incremental reach for yield. And that reach for yield is in conflict with the desire for the main corpus of fixed income to provide safety and liquidity. And so we would encourage separating safe haven fixed income and what we would label as return-seeking credit. You can see in the chart below, there's an area of, treasuries, TIPS, safe haven, and you look at, common asset classes that would be considered return-seeking credit, very different profiles, both from return and risk perspective. And we encourage to, not think of these as overlapping Venn diagrams, but keep them separate to manage the mandates, manage liquidity, and align with kind of the objectives and goals that you have from a risk return perspective. And when we think about the credit space, it's much more difficult in our minds to deploy capital and credit when we look at the long-term return outlook. But what's unique about credit is there are more implementation options in the space than you would have in maybe other types of asset classes. So really consider, how one deploys capital in this space. Think about where you take tracking error risk. Think about what's the return opportunity relative to strategies and investment managers maybe have unique credit expertise. And it's really finding that comfort level and that risk tolerance across a range of complexity and tracking your options. Some cases it might be, a simple blend of high yield bank loans and emerging market debt. Others, it might be thinking about a more active allocation shift that as credit spreads rise, you move into high yield. As credit spreads fall, you kind of shy away from it. And other is there areas in the private debt markets to deploy capital in kind of niche private exposures, or even in some cases in the hedge fund space, finding specialized credit hedge fund managers that can deploy capital in securitized markets where we still see some return potential. And that takes us to our broad overview of our capital market assumptions. These are assumptions that we've started to publish every quarter for clients to be made available. Not in the sense that we want people doing quarterly asset allocation reviews, but that way you can do an asset allocation review on your own timing at some point during the year. And I think the broad statement is we see lower returns across most asset classes, but also there's information content in those return differentials. And as I mentioned, the difference between equity terms and cash implies there is a benefit to holding equities. And we think a lot of the thematic issues we see in the market supports that notion, whether it's, higher equity valuations that maybe can stay higher than history would imply, and recovery that we see in those assets. And so last is just a quick snapshot of some of those numbers. I mentioned, just to draw your eyes to a couple numbers, I mentioned, the differential, let's say, between cash and U.S. equities or global equities, which is, a larger differential. And the last piece is we acknowledge that, fixed income yields are low, but when we think about safe haven fixed income exposures, whether that's treasury bonds, TIPS, or others, even though these returns are low, these are really insurance policies. They're there to provide protection and encourage, adopting that focus to provide, that risk-off mitigation in the portfolio. So now I'm going to turn it over to Jen Appel to provide some thoughts on inflation, which is historically something we haven't spent a lot of time talking about in recent years. I want to turn it to Jen to provide some thoughts.
Thanks, Phil. I think this is a really interesting topic since, as Phil just mentioned, inflation is always a risk to portfolios, but it's a risk that we as investors and as advisors haven't dealt with for a while. And while we aren't making a big call on inflation one way or another, we think it's important to be aware of how inflation will impact your investments, and ultimately that should influence the decision as to whether adding some inflation-sensitive exposure might make sense. So with this in mind, looking to the long-term history of the Consumer Price Index, or the CPI, we've been in a really muted and kind of range-bound inflation regime for the last few decades. Some of this is a result of the central bank interventions, as we just heard, but it's also a reflection of really powerful deflationary forces like demographics or technology at play. And so as a result, we've seen more muted headline CPI figures and also less inflation volatility than we had seen historically. So while our base case here at NEPC is not calling for high inflation, we do think that this is a key risk for markets, since low inflation and really the expectation for that to continue is baked into market pricing across the board. Now, as we look through a different lens, breaking this out by major categories is an interesting way to think about where a higher inflation print would actually have to come from. Many of these small peaks and troughs are driven by the energy component, which is typically the most volatile in the series. But as we think about this on a go-forward basis, we expect that energy prices likely normalize, pushing the CPI a little bit higher, but that does tend to be a little bit more cyclical in nature. That said, there is in some sense a tail risk should energy prices be driven materially higher by a supply shock or some other exogenous event that could certainly be inflationary over the long term. Beyond that, looking to some of these other components, both food and commodities, ex food and energy, have historically been pretty minor contributors to the overall CPI print. So while we've seen some inflationary pressures in these areas, specifically with the pandemic-related disruption, it's kind of too small to move the needle. So what that means is that services, the light blue bar, are likely the area that we need to see price pressures to have a meaningful inflation print. And if you think about services, this category includes things like shelter or healthcare, even personal services like a haircut or a car wash, just all the things in that spectrum. So in order for us to have building inflation pressures there, we'd likely have to see some changes flowing through in the form of wages or input costs that could be passed on to consumers, or even shelter costs, among other things. And given the current state of the economy, these price pressures seem a little bit less likely to transpire. That said, on the next slide, the inflation risk is a real one since it touches so many different parts of the economy and of capital markets. It's not just the determining factor for real savings and real returns, but there's a larger economic component for monetary and fiscal policy, for interest rates, for business competitiveness, and importantly, for investment returns and forward-looking expectations. And it is really important to think beyond just the CPI that we just showed. Even though that is the most commonly used kind of broad inflation metric, it is more of an economic indicator, when in reality, there are a lot of different ways that you could measure and define inflation, whether that's specific to a business, if your input cost changes, or if your individual spending basket's going to change, or kind of more simply, how inflation flows through to asset pricing and return expectations. So we think it's really important to think about inflation in all those different ways and to understand which types of inflation are going to impact your unique needs and objectives. So now getting back to the outlook, like I mentioned, we still have a pretty benign inflation outlook, but we wanted to highlight that there are a number of theoretical factors that could lead to a higher inflation environment over the long term. Just a couple examples on this screen. Over the short to medium term, a successful vaccine rollout and widespread distribution could unleash a flurry of economic activity as conditions normalize. We could also experience what we're calling healthy economic inflation, where price pressures start to build from an economy that sees increasing productivity or wage increases, maybe growth in consumption, kind of all of those good factors at play that could bring about some normalization to inflation and rate expectations. So these are just some of the factors that we take into account when forming our long-term outlook. And as we think about this outlook from a portfolio construction standpoint, on the next slide, we want to be really thoughtful about where the biases present in portfolios are and make sure that they're aligned with investor objectives. As you can see on screen, most investors already have some inflation sensitivity embedded in their portfolios, but for some that are more sensitive to the inflation risk, a more dedicated inflation exposure, perhaps through real assets, will make sense since those have the broadest inflation beta among public markets. And that can certainly be challenging from an implementation standpoint, given the historical performance and expected risk return profile of a lot of these inflation hedging assets during quote unquote normal environments. So to further that point, on the next slide, we looked at a regime-based Sharpe ratio analysis. Now, over the last 50 years, this set of asset classes that were included in the analysis have had positive Sharpe ratios or positive risk-adjusted returns. And the assets that tend to have the largest portfolio weights, like equities and bonds, have done really well, while commodities and gold, for example, have lagged. But looking to some of the other regimes listed here, this highlights where having some diversification can help balance the risks arising from different economic and different inflationary regimes. So we've highlighted two different examples here. With the growth rising inflation environment, for example, we could see that healthy inflation pickup, and that's a good environment for growth sensitive equities, but also inflation sensitive commodities, versus the defensive rising inflation environment, which we view as more of a tail risk that would likely coincide with the end of our permanent interventions theme. And in that case, that's where some of the inflation hedging assets really shine compared to the traditional assets. So we think this framework is really helpful in showing where inflation-sensitive assets can work well from a portfolio construction standpoint, but it's definitely a balancing act between sacrificing returns in certain regimes and the expected benefits during these different inflationary environments. So to bring that all together, both NEPC and the market continue to forecast fairly benign inflation over the long term. That said, we do believe that there are a wider range of potential outcomes for inflation on a go-forward basis. And with that in mind, we remind investors that it's important to really understand where their inflation sensitivities might be and to consider adding inflation hedging assets if that makes sense in the context of their objectives. And for those that are considering allocating to inflation-sensitive assets, we'd really encourage this exposure as something complementary to the safe haven exposure that Phil mentioned, since it helps withstand and kind of diversify for a different type of environment or regime. So with that, I'll turn it back to Mike for some questions.
Great, thank you, Jen. I appreciate it. You too as well, Phil. We do have some great questions coming in, so I'm just going to jump right in. And Phil, we're going to start with you. And while we're going through the questions, here is an update on our client conference, which is going to take place virtually, Tuesday, May 4th, and Wednesday, May 5th. You're going to be getting save the date, but just want to remind people about that and look forward to connecting with you there, albeit in a different format. So Phil, maybe jumping in first, you talked about permanent interventions, as a theme that has been in the NEPC playbook for a while. How permanent do you think these permanent interventions can be, and how does that factor into our outlook?
Yeah, thanks, Mike. It's something we discuss as a group quite a bit, is how long can this theme sustain itself? And we've tried not to make a prediction of, how long it can last, but understand what are the factors that could cause it to be disruptive, or be disrupted. And I think the discussion that Jen just walked through highlights that really inflation is what we view to be the most critical risk to that permanent intervention theme. So if we see, inflation surprises rise to a level that the Fed has to move off of an easy policy to a more tighter policy, we think this is one that, disrupts that permanent intervention theme and starts suppressing valuation multiples. I think the other is related to inflation as well, but also is a longer term tail risk, let's say, but revolves around the prospects for the U.S. dollar. It's not a concern today, or one that we have, let's say, in the next 5 years, but a long-term secular weakness of the dollar, can that bring inflation pressures, and does that disrupt the permanent intervention theme as well? And I'd say, kind of in summary, this is a theme that, as we look at it today, we don't see inflation coming from our baseline outlook. So we think permanent interventions can sustain itself for a while, but that's always in the back of our minds. This is the item that could be the disruptive factor.
Great. Thanks, Phil. And maybe if we go back to the prior page where we talked about the growth in defensive inflation regimes. Jen, you talked about that. You went through it fairly quickly. Maybe just provide that context again. What do you mean by defensive and growth and then the inflation? So maybe just provide a little bit, that a newer concept for us, and so just wanted to, and then in your analysis here, so just give us a little more context.
Sure. So this is a macroeconomic model that we run where we try to kind of segment the economic state into growth, neutral, or defensive. And we do that by looking at various financial and economic indicators, both their levels and the trends in them. So the growth environment, for example, would be where we have favorable economic and financial conditions. Typically, that would be something like a positively sloped yield curve, strong investor and consumer sentiment, among other things. Whereas a defensive environment would be quite the opposite. Maybe we have an inverted yield curve, or the data is trending more negatively. But I really think that this is a helpful framework for looking and seeing where certain asset classes can perform quite well compared to more traditional analyses.
Thanks, Jen. So I'm going to come back to you with a question again on inflation here in a minute, but Another question was, what is NEPC doing to advise clients regarding employing ESG or SRI strategies? And so thank you for this question. This has been an important part of our research effort and our commitment to clients over the past, probably at least 7 years, in terms of, started really with a few clients who are interested in this, and now I think NEPC has really been a leader. We're signed on to the PRI, the Principles for Responsible Investing. We've got a dedicated impact investing team, which covers everything from ESG to more targeted or focused types of investment strategies. So this is we love seeing the focus on the governance and environment and the social governance aspects really come in to the forefront, and that's a question that we're working with all of our high-rated managers, trying to understand and give a rating to them on how much that is factoring into their own investment process. So would love to take the opportunity to discuss in more detail and have you connect with members of that team if it's something that's really important to you. And again, we've loved the trend that's happened. We think it's going to continue down that path, and are happy to engage with anybody who wants to have that conversation. So Jen, I promised you have one more question on inflation, and then Phil, I'm going to have one more back for you, and then we'll wrap up. We talked about inflation, and something that I think you talked about investors had to think about it for a long time. But going back to the last 10 years ago, coming out of the global financial crisis, there was a big fear with all the money printing that it would lead to inflation. Why do you think what's different about today than was back then, and why is this more of a focus?
Thanks, Mike. This is a good question. So as you mentioned, post GFC, we had all this quantitative easing, and the consensus was that that would sow the seeds for future inflation, since you're putting a lot of money and a lot of liquidity into the system. But what we actually saw was asset price inflation. That didn't really translate to the real economy, because a lot of it just ended up, going back to financial institutions and banks to shore up their balance sheets and improve their financial standing, among other things. And so the result was a lot of that transferred exactly to capital markets. And so we didn't get the inflationary pressures that we expected. So why would this time be different? Well, as Phil showed in one of the charts, the scale of the stimulus response is much larger than we showed from both than we had, from both a monetary and fiscal standpoint. And so as we see some of the money supply increases, it's a natural next thought that inflation must be coming. But in order for this to be inflationary, we'd have to see this money go back into the economy to prop up demand. So I think this time around, with all the different rounds of fiscal stimulus and the greater reliance that we're expecting on fiscal stimulus going forward, it's more likely that we'll see that money being put back into the real economy than it was during 2008.
Great, thank you. And we'll maybe go ahead and finish up with one last question. And I apologize to those of you. We've had a bunch of questions come in here in the last couple of minutes, just not able to get to all of them. But please do reach out to the folks you connect with at NEPC, and we're happy to address those. So Phil, last question, and this gets back to the safe haven assets. And you talked about safe haven for a corporate pension plan might be really different than it is for an endowment or a hospital or a family. How do you think about the different idea of safe haven assets, and how do you assess what a baseline target might be for a commitment to those assets? And I know it's going to be very different by client type and by client, but just a general answer as we think about portfolio construction.
Yep, that's a great question. And I'd say the one universal piece across all portfolios is ensuring you have kind of sufficient level of liquidity. So whatever that may be relative to spending needs, or how monies come into the portfolio, or capital commitments related to private markets. But thinking about what are those spending needs, understanding kind of the stress case scenarios, and do you have sufficient capital to help to help meet those needs and without having to sell, let's say, assets that would be stressed in a period of market turmoil. So in some ways, do you want to be relying on equities to be your sole source of liquidity after markets have sold off, 30%? And we think, that's true for each of the different clients. And I think the important piece is tying it back to objectives of building that allocation to, help, mitigate the economic outcomes related to, whether it's the liability structure or the long-term investment goals. And the safe haven's really there broadly for, downside protection, liquidity, and deflationary risks. And thinking about, as Jen mentioned, having other areas of the portfolio to help deal with that inflation sensitivity, if that's a risk that's needed to be, quote, hedged in a portfolio relative to, each individual's kind of unique risk tolerance.
Great, Phil. Well, with that, we're going to go ahead and wrap up. And again, apologize to those folks whose questions we couldn't get to. I want to say thank you to Phil and Jen for really doing a great job putting this together and answering the questions. And then thank you to the folks who stayed on, listened to us. And, we're really excited to continue to work with you this year to bring out our investment ideas to help you meet your investment goals. And honestly, to get together and connect in person. That's such a great part of our business. We're sad to have missed it over the last 12 months and look forward to connecting with everybody soon. So stay safe, and we look forward to connecting with you. And if there's anything we can do, please do reach out to your primary connections at NEPC, or you can always reach out to me directly. So thanks again, and have a great day.